everyone, it's Katya and welcome to my channel. Today we are talking about interest rates, fixed and variable. So let's get started. When talking about interest rates, first thing we need to know is what an interest rate is made of. It's made of two parts. The first part is a prime rate, which is changing, and the second part is a margin, which stays the same. I spoke more about interest rates in my other video. I will include a link for you guys in here if anyone is interested. First things first, let's talk about fixed interest rate. So fixed rate interest rate is kind of a safe harbor because fixed rate interest rate stays fixed throughout the life of the loan. It's a great option when the interest rates on the market are low because that way you can lock in your low interest rate for the life of the loan and have a low payment. Now, the only downside of a fixed interest rate is that fixed interest rates are usually a little bit higher than adjustable interest rates. Secondly, let's talk about variable interest rates. So variable interest rates are also called floating or adjustable. Why variable interest rates can be a great option for you? Well, first of all, because the way they structured, it consists of two parts. First part is a prime rate, which is changing the prime rate or federal funds rate or bank transfer rate. It has a few different names. And the second part is a margin. Margin stays the same from the moment you got the loan until you pay it off. For example, if the prime rate right now is 2% and your margin is 2% as well, the interest rate that is offered to you will be 4%. Now, when you are getting to the part when your interest rate switches to a variable interest rate, let's say today's prime rate is 3% and your margin still stays the same, so your interest rate will jump to 5%. The same goes for an interest rate if the prime rate goes down. So let's say if the prime rate went down to 1%, you still have a margin of 2%, so your interest will be 3%. Now, there is a little thing that you have to keep in mind. Even if a prime rate will be 0%, you will still have a margin. You will still have to pay a margin of that 2%. So keep that in mind. Now, what's a great option about variable interest rates as well? Usually those are a little bit lower than a fixed interest rate, for example. And if you are looking to have your mortgage for a short period of time, for example, you bought fixer-upper or you bought a like a rental property for a few years, it's a great option because that way you are locking in your interest rate for a short period of time, and then you will switch to adjustable interest rate. Let me give you a little bit more detail about variable interest rates. So majority of the times, the mortgages that we are getting with the variable interest rates are either 5/1, 7/1 or the 10/1 ARMs. Those are the most common ones. Let me give you a little bit more details on those. 5/1, 7/1 or 10/1. First number indicates a number of years in which interest rates will be fixed, and the second number indicates how often the interest rate will be changing. In our case, it's 1, so it will be changing annually. Now, why an adjustable rate mortgage is a great option? Well, because if, for example, today is 2021, outside the interest rate's already low, the way it works, you lock in a fixed interest rate for, let's say it's 5/1, so for the first 5 years you will have a low interest rate, and for the remaining, your interest rate will be changing depending on what condition the market is in. So let's say if you're taking a fixer-upper, you are able to have a fixed interest rate for first few years. It gives you enough time to fix up your property and resell it. And additionally to that, as I mentioned previously, the interest rates on adjustable rate mortgages are lower than on the fixed rate mortgages. So to help to protect the consumer, every single variable rate has its caps. So it's a certain limit which cannot be exceeded, which your interest rate cannot go over at any given point of time. There are two different caps. The first cap called a lifetime cap. So your interest rate at any point of time, your interest rate cannot exceed this cap. For example, if your cap is 6% and a prime rate today is 5% and your margin is 2%, well, your interest rate is not going to be 7%. It's going to be 6% because you have that cap. Additionally, there is a periodical cap. Periodical cap stands for a year-to-year changes, so it's a certain cap which your interest rate cannot exceed throughout the year when it changes from the year to the year. Just a little side note, when talking about adjustable rate mortgages, there is a thing called payment cap. So for example, your payment cap is $1,000 and your today's interest rate is low and your payment is, let's say, $800. Well, next year you are a variable mortgage, so next year your mortgage is changing, and let's say your payment jumps up to $1,200. Well, you only be paying $1,000 because you have a cap at that $1,000. The only problem with that is you will be building up a negative amortization because the payment that you are due and payment that you are making is not sufficient enough to cover everything that you are due. So therefore, you will be building up more debt instead of paying it off. You will be due more funds in the end result instead of paying everything off. So when considering adjustable rate mortgages, please explore all of your options and make sure that you are aware of everything and you are aware of how everything works and what you're signing up for. So to sum up, a fixed interest rate is a safe option for someone who is a first-time home buyer or for someone who is looking to keep their mortgages for a long time, especially if the interest rate on the market is low. Even if it's not low, you can still refinance in a few years and get a low fixed interest rate. Now, if you are looking to buy something for a short term, please look into a variable interest mortgage rate because that can potentially save you some funds which you can dedicate to some other projects that you have. It's a great option. It's something that you definitely can consider. However, you need to know what you're signing up for, and you need to make sure that you understand how variable rate mortgages work so that you will be safe as well. Thank you so much for taking time to watch this video. If this information was useful for you, please click thumbs up and subscribe button so next time my video comes up, you folks will be notified. If you have any questions, please feel free to reach out to me or comment below and I will be more than happy to assist you. Thanks again for your time and you folks have a great one.